The 4-step method to high-performance trading and the 7-step daily routine for high-performance traders are both free downloads. The 4-step method for high-performance trading is about developing the mindset and the routines to increase your competence and your ability to execute your trading edge in a live trading environment. Constant progress. 7-step daily routine for high-performance traders is an audio program download designed to help traders bulletproof their day-to-day habits, discipline, and develop a winning mindset. Again, the link is in the description box below. They're free downloads. Let's get started. Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're going to be reviewing the monthly rotation of instruments and understanding week 1, week 2, week 3, week 4, how the economic calendar impacts each week with major red news, and how we can help our thesis when we're building a best playbook trade setup, and how we can identify best setup, best instruments that are setting up for momentum or parabolic opportunities each week. 1 or 2 scalable opportunities that align with our larger time frame thesis. So what is our larger time frame? Our higher time frames is the week 1, week 2, week 3, week 4 in a monthly rotation. Talk about new timing cycle in the monthly rotation of how those instruments can trade back and forth, especially on currencies. We'll be looking at currencies, but understanding that each week we have high impact news in most cases, and certain countries will have high impact news, rate release statements, CPI, etc. But the general monthly calendar for the US dollar, we have week 1, we have non-farm payrolls. Typically week 2, we will have CPI and PPI. Week 3, and not always, but in the normal case, we have FOMC 2-part release. We can have that overlapping on other weeks. And then week 4, the closing range of the month. So week 1 typically opens the new month. We may be near or at a previous monthly high, and we can help identify candidates that may be trading at those levels to identify higher probability opportunities. And then, of course, the closing range of the month, where a market may be reversing into the close, whether that's from the long direction back inside or from the short direction back inside, closing out the month. So when we get our signal days, we can align that with the larger template that's already in play. We can have 3 days of breakout traders, first red day, first green day, and the inside day signal days. Looking at any instrument, we can just go and look at the month and how those instruments are trading, and looking at how each instrument may set up throughout that month with our signal days, aligning that with the larger template in play. Now, if I mark these days, just starting off our week 1, non-farm payrolls was on a Friday. Our following week breaks out from the previous week's low. We have a market now in breakout, Friday closing the week as an inside day. Now, this is where traders can get caught up. They're looking for first green days into a breakout, and same thing goes for first red days into a breakout. But we're in breakout week 1. Week 2, we have CPI and PPI, and on the back side of the week, that market continues to break down. We had an inside day on Wednesday, first red day, and on PPI continues to blow off and close in breakout on week 2. Traders will look to call this first green day, but we're trading back up into the market that has broken down. Other time frame or higher time frame sellers selling at this level. We have FOMC, so again, avoiding the market until after high impact major red news. Some traders may choose to be trading that at the high of the week before breaking down and closing as a first red day and coiling sideways into the close. Lower lows breaking down further on week 4 and blowing off into the low of the week before an inside day Thursday, the signal day, the first green day, closing out the month. A first red day on non-farm payrolls inside of a larger 3-day first red day template. Week 1, week 2 CPI, PPI, week 3 FOMC, and week 4 putting a peak formation low in before pulling back inside of that weekly range. Still closing in breakout. So understanding in this particular example, we have a market that just is continuing to break down. A lot of traders will be looking often to just counter trend something because it's down low. We have a monthly cycle at play, a larger, higher time frame cycle at play in this particular example. If we follow that into the new month, that cycle begins again. Week 1, non-farm payrolls. Week 2, we had an FOMC, just a one-part minutes, meeting minutes on the Wednesday, but CPI on Thursday. That market on week 3 now, we can look at first red day, first green day, and relating that to the template in play. So the purpose of understanding this is so that traders are not constantly just calling every down day a first red day or every green day a first green day. What type of setup do we have? What is the larger time frame template? Now we're just looking at this randomly, not to suggest that any of these are best trade candidates, but getting yourself into the process of understanding week 1, week 2, week 3, and how that economic calendar repeats monthly. Now, individual currencies are going to have high impact events that will affect their templates, rate release statements, CPI, Bank of Japan, those types of high impact related news calendar events, but understanding week 1, week 2, week 3, and week 4, and then the process begins again. And then using that calendar to your strengths to hunt out the candidates that are offering you the 90-10 best playbook trade setups. And if we continue that again into the new month, we have our open in our new month in a week that ends on a non-farm payrolls, and we have a peak formation low, breaking out, closing in breakout at the end of that week after non-farm payrolls. Heading into week 2, we have a first green day on a Monday, and day 2, Tuesday, typically expands the range. We have CPI exploding. This is an example of potentially where a first bounce opportunity would have aligned with a larger time frame template, a market that's in breakout, pulling back, coiling sideways into the new week before exploding. PPI on Wednesday, the market coiling again into the close of the week, closing in breakout again on week 2. Week 1, higher highs, dump and pump. Week 2, higher highs. Week 3, higher highs, dump and pump, again aligning our time frame signal days with the larger time frame template thesis, front side of the week, back side of the week. And then, of course, week 4, the last week of the month, putting in a peak formation high before breaking down and collapsing into the closing range of the month. An example, again, where the market closes at the end of the week and opens a new month on a Friday. Whole point is understanding how high-impact news releases can give us insight into aligning our signal days in tune with the higher time frame thesis, and then finding the candidates that are offering us the best trade setups, whether, even though we may have a thesis in place for what a market's going to do, it's which instrument is going to give us the best setup front side or back side of the week in the session that we're trading, and not just blindly calling every down day a first red day or every green day a first green day and looking for a trade. What is the larger time frame template setup? We're looking for easy, simple, rinse and repeat trade setup opportunities, aligning ourselves with the higher time frame template. So some homework for you just to consider is to go through your instruments and understand week 1, week 2, week 3, week 4 in the monthly timing cycle, and how high impact news events each one of those weeks relating to those either individual instruments or the larger U.S. high impact news candidates, and looking at the larger time frame template as it evolves over the course of the month. This helps keep things simple because instead of just looking for down days and up days, we're actually aligning ourselves with the higher time frame template, whether that's currencies, indexes, metals, or energies. The whole point is just to be able to identify 1 or 2 best trade candidates in the week itself that are scalable opportunities for rinse and repeat in the session that we're trading. So instead of getting lost in cycles and pushes and counts and gaps, hunts, sweeps, whatever else there is, just keeping things really simple and understanding that we are in a market that is trading from month beginning to month end. When one month ends, a new month is beginning, and so does the economic calendar and potentially high impact news-related events that can help us identify candidates after the news has been digested by the markets. Similar to day 1, day 2, day 3, we can work in the same headspace as week 1, week 2, week 3, the opening week of the month and the closing range, the closing week of the month. Week 2 can typically expand the range, and sometimes that will be related to a high impact news event catalyst, which is where we were looking for potentially first bounce or first bar opportunities if an instrument is indeed set up for a best playbook trade setup. Guessing is not a good long-term strategy. Align yourself with simple templates, simple trade setups, 1 or 2 a week, rinse and repeat, and keep it simple as possible. Have a great day, traders, and may the markets go with you.